Let's just dive right in, shall we? Welcome to today's Explainer, where we're going to take what is notoriously a dense, complicated accounting rulebook and transform it into a really clear, visually structured journey. Look, if you've ever felt completely overwhelmed by the sheer volume of rules in MFRS 9 and MFRS 7, you are absolutely in the right place. Today, we're decoding the entire life cycle of financial instruments and hopefully finally bringing some relief to making sense of these massive standards.
So, this comprehensive infographic, it might look like a totally chaotic web of technical jargon at first glance, but if you look a little closer, it actually perfectly outlines the entire birth-to-death lifespan of a financial asset. It maps out all the heavy hitters: recognition, classification, measurement, impairment, and disclosure. We're going to break this giant map down piece by piece, so by the end, it all makes perfect sense.
Here's our roadmap for today. 1. What are financial instruments? 2. The classification sorting hat. 3. Measuring costs and values. 4. The expected credit loss. And 5. Hybrids, disclosures, and derecognition.
Okay, starting with Section 1. What are financial instruments?
According to the standard, a financial instrument is really just a contract. It's a contract that gives rise to a financial asset for one entity and a financial liability or equity instrument for another. Think of this initial recognition as the instrument's birth certificate. You officially recognize these assets and liabilities on your books at the exact, precise moment your entity becomes a party to those contractual provisions. Not a day before, not a day after, right when that contract is executed. The paperwork itself is the catalyst here, not the actual exchange of cash.
Moving on to Section 2, the classification sorting hat.
All right, our first major test for financial assets is SPPI. That stands for Solely Payments of Principal and Interest. This acronym is basically the fundamental DNA test for debt instruments. It asks a really simple question. Do the contractual cash flows of this asset consist only of principal and interest on the principal amount outstanding? That one test determines exactly which classification bucket these debt instruments belong in, based purely on the nature of their cash flows.
Notice the high contrast here between debt and equity. Debt instrument paths are entirely dictated by that SPPI DNA test we just talked about, combined with your underlying business model, whether you're holding to collect or holding to collect and sell. Equity instruments, on the other hand, they are an entirely different breed. They don't have SPPI. They actually default straight to fair value through profit or loss, or FVTPL. But there's a catch here. You are allowed to make an irrevocable election at inception to measure them at fair value through other comprehensive income, FVTOCI, just as long as they aren't held for trading. It's a completely different logic path.
Now, flipping over to the liability side of the sorting hat, it's actually way simpler. Most financial liabilities safely default to amortized cost. That's just the baseline. They only go to FVTPL if they are actively held for trading or if management strategically designates them under the fair value option. And you might wonder, why would they do that? Well, usually it's a very intentional corporate strategy designed specifically to eliminate or at least significantly reduce an accounting mismatch that would otherwise pop up. It's really just a pragmatic exception to the default rule.
Which brings us to Section 3, measuring costs and values.
As you can see, everything starts at day 1 with initial measurement, which is usually recorded at fair value. Then, as reporting periods roll by, we enter subsequent measurement, literally tracking the value as the asset or liability works for the entity over time. And finally, we reach the maturity date, or the point of derecognition. It's this continuous, highly logical journey tracking the instrument's financial weight during its active working life.
Now, a vital fork in the road during that day 1 initial measurement is how we handle transaction costs. This is a high-stakes decision, and it is dictated completely by the instrument's classification. If your instrument is classified as FVTPL, any transaction costs are expensed immediately to profit or loss. They're just gone right off the bat, hitting the income statement instantly. But if you have an asset at amortized cost or FVTCI, those transaction costs are capitalized, meaning they're added to the initial carrying amount of the asset or they reduce the initial liability. So it literally changes the math right out of the gate.
As the instrument matures over reporting periods, we obviously have to measure it again and again. And knowing exactly where those value changes go is absolutely crucial. This framework shows us where subsequent changes must be reported on the financial statements. So, for amortized cost, we use the effective interest method. We track a carrying amount using the opening balance plus finance income minus cash received. Simple enough, right? But for FVTPL, any fair value changes hit your profit or loss directly. That impacts the company's bottom line immediately, which is obviously a massive deal for stakeholders. Meanwhile, for FVTOCI, those fair value changes are parked safely away in other comprehensive income. So that's 3 classifications and 3 completely different impacts on the financial statements.
Moving right along to Section 4, the expected credit loss.
Here is where things get really predictive. This represents a massive shift in accounting standards. MFRS 9 introduced the forward-looking expected credit loss, or ECL model. You see, under the older standards, you actually waited for an incurred loss event, like, say, a missed payment, before you recognized an impairment. Now, instead of waiting for a loss to actually happen, the standard requires us to proactively look into the future to predict potential credit issues. This applies to financial assets at amortized cost, debt assets at FVTOCI, loan commitments, and certain receivables.
The absolutely crucial point here is determining the asset's current health trajectory. For relatively healthy assets, where there hasn't been a significant increase in credit risk since initial recognition, you apply a 12-month ECL. You're only accounting for potential defaults in the next year. But if the credit risk has increased significantly and the asset's health is deteriorating, you have to step up and recognize a lifetime ECL. You literally have to account for expected credit losses over the entire remaining life of the instrument. It's a huge shift in how much risk you recognize on the books.
And finally, Section 5, Hybrids, Disclosures, and Derecognition. Let's look at a hybrid instrument, something like a convertible bond. When you're dealing with a hybrid, you can't just lump it all together. You have to carefully split its complex DNA into separate liability and equity components, step by step. First, you identify the liability component by calculating the present value of the principal and interest. Second, you figure out the equity component. You do this simply by taking the total proceeds and subtracting that liability amount you just found. Then, moving forward, the equity piece stays unchanged, while the liability piece is measured using amortized cost. It's actually a brilliant, really logical way to unpackage a complex asset.
Now, what good is all this calculation without transparency? That is exactly where MFRS 7 comes in as the ultimate transparency tool. It mandates that entities openly disclose the significance of these financial instruments on their financial position, performance, and cash flows. It also requires really detailed disclosures around key risks, and think of these not just as lists, but as actual tangible dangers companies face every day. We're talking dangerous exposure to credit risk, paralyzing liquidity risk, and volatile market risks like currency and interest rate fluctuations. Oh, and don't forget derivatives, forwards, futures, swaps, options. These are always measured at fair value, with changes generally going to profit or loss, and MFRS 7 makes sure investors see exactly what's happening with them.
Look, every financial instrument's life cycle eventually concludes. This is called derecognition. For a financial asset, this happens when the contractual rights of the cash flows expire, or when those rights and all the associated risks and rewards are completely transferred to someone else. For a financial liability, it's derecognized only when the obligation is truly discharged, canceled, or expires. Once those conditions are met, the instrument is finally wiped from the books.
Okay, let's wrap this up with a special section, the ultimate cheat codes. Now that we've mapped the entire life cycle from start to finish, I want to reward you with some ultimate study guide cheat codes derived directly from our source infographic. These are 4 straightforward formulas that literally compress the most challenging MFRS 9 rules into easy-to-remember equations you can take with you. Rule 1. If you have debt, it passes the SPPI test, and your business model is strictly to hold it, that equals amortized cost. Rule 2. Debt plus SPPI, but you intend to hold and sell, that equals FTOCI. Rule 3. Any items you are actively trading will almost always drop straight into FTPL. And Rule 4, the golden rule of modern impairment, impairment now uses expected credit loss, never the old incurred loss model. Seriously, memorize these and you've won half the battle.
And that brings us to the end of our explainer today. But I do want to leave you with a final thought to ponder. If an instrument's lifecycle is so neatly predictable through SPI tests and business models, how might unexpected global events test the absolute limits of those forward-looking expected credit loss predictions? I mean, while these MFRS rules certainly tame the chaos of financial reporting, one has to wonder, is any forward-looking impairment model truly robust enough to predict the next unprecedented economic shock? Definitely something to think about the next time you look at a balance sheet. Thanks for joining me today, and keep learning.